I'm here to pitch Chart Industries. Pretty excited about this stock. We've actually been adding to it as recently as earlier this week. Before I get to it, I'm going to talk a little bit about Stone Oak and our strategy and how we have done till now. Stone Oak Capital, we're concentrated, long bias, value investing. Um, Primarily, but not exclusively in U.S. equities. Again, we were founded in 2017 with the portfolio track record going back to the predecessor account in 2015. We're small, we're a startup, we're looking for capital. We got just about 5.5 million AUM across separately managed accounts. I try to explain our strategy in a way that's different from a lot of the other value managers out there. Um, you know, we're a value manager that likes growth. We like everything. We're greedy. We like everything all in every single one of our picks, which is concentrated. So I came up with the phrase "special companies in special situations," bought at a large margin of safety, and I'll get into that in a minute. They're probably what they sound like. Special companies are your typical compounders, high quality, disruptive companies, special situations. Something has happened that has made the stock undervalued or difficult to value or cheap. We have a wide style aperture. So even though we're concentrated, we'll go anywhere. Our second largest portfolio holding is a $200 million micro cap, and our third largest holding is Microsoft, the largest company in the world. So we'll go anywhere in search of the very best risk reward opportunities. We only invest in companies with substantial upside, but we size positions according to risk. We are open to all sectors, now primarily focused on technology. And as we'll see, Chart is an energy transition, industrial pick, very much an infrastructure, revitalization of a manufacturing a stock. We have a long-term orientation, especially when we have a compounder that we like. We've held some positions for 5-6 years, and maybe even longer. The portfolio is 9 years old. We are fundamental investors, but we are, I would say, technicals aware. We understand what technicals are, and we'll look at them maybe to try to time trades, maybe to assess if we should wait on a trade, or if we think something is breaking out. We'll also use options lightly to either generate income, add leverage to positions, or hedge. Again, we're long biased. We'll ask for the freedom to take small short positions and maybe use a modest amount of leverage opportunistically. So again, Stone Oak. I'd initially named the firm Stone Oak because I thought that's what Duberstein meant in German. I don't think that's what it actually is named, but thinking about why it the name resonated with me for an investing firm, you think about stone, you think about downside protection, value, solid competitive advantages. You think oak, something that can grow higher and out in numerous directions. Based on management skill, new products, improvements, and real dynamic companies. We seek investments that have elements of both of these. Often one comes at the exclusion of the other. The opportunities are hard to find. We like to think if we scour enough companies and we're selective enough, we can find enough of these opportunities to concentrate in. Again, special companies, special situations. I've, gone on a bit of a rant about these, but here you can see some of the criteria for each. So special companies, wide moat compounders, high and growing ROIC, excellent management, often owner operators. Special situations, you get your transformative mergers, and that is what Chart is, which we'll get into in a minute. Internal setback that is temporary, misunderstood or underfollowed companies, business strategy change, something falls below book value, your nets, arbitrage, your typical deep value. And while it looks like we have two targets, again, we probably won't invest in something that doesn't have an element of both of these. So it can either be a really special compounder that we think has fallen to a reasonable price, so a company that is a decent quality company that has become extremely cheap. Ideally, if we find a special company that has really gotten cheap, we'll concentrate heavily. And again, we like to say we don't pick one list or the other. We like to pick criteria from both sides of this list. So I think I've gotten that point across. We've had a pretty good run, especially recently. Here's our performance. We've compounded 6.9% since inception through January. Our fees are negotiable, but as a theoretical 1 plus 10, we've compounded at a net 14.2% compared to S&P 500 just under 12 and the Russell 2000 6.8. I also want to point out the trailing 5-year performance, 2019 through 2023, we've compounded at 24%, 24.1%, and 21.2% net. So we've had a good run. I like to think we are getting better with age and hitting our stride. I think that has outperformed, I don't have the numbers in front of me. I think that's outperformed the S&P by about 10 percentage points over that time, 8 to 10. So now let's get into chart industries. There's a lot that goes into chart, but I wanted to make a very simple thesis point so that everybody can grasp onto it. There's one main overarching theme here. In November 2022, Chart made a large acquisition of an equal-sized company named Howden from a private equity owner. The market hated it. We love it. That's basically the main theme of the pitch here. And here's a Phil Fisher quote, one of my favorite investing influences. Every significant price move of any individual common stock in relation to stocks as a whole, that's alpha, occurs because of a changed appraisal of that stock by the financial community. There's a lot of pessimism in chart right now. You can see from our performance, we've had a lot of stocks do well, but this is one we've been adding to more recently. So chart industries, you might be wondering what the letters GTLS has to do with the name chart. Doesn't seem like it fits. The GTLS stands for gas to liquid solutions, and that's a good anchor for everyone who's wondering what chart does. They're US-based industrial with a leading position in cryogenic tanks, heat transfer systems, for any molecule that needs to be converted from a gas to liquid, vice versa, purified, safely stored, often at extreme temperatures. Their products include stationary storage tanks, brazed aluminum heat exchangers, liquefiers, dosers, valves, vaporizers. With the addition of Howden, they've added a rotating equipment portfolio of compressors, heaters, blowers, steam turbines. It's highly complementary. Both Chart and Howden equipment goes through the entire value chain, from the production of the molecule to the transport of the molecule to the storage and the end use. Chart's been a leader for a while. They're generally number one or number two. They have a very diverse portfolio, but in any individual piece of equipment, they're usually the number one or number two provider. For instance, they're only one of 5 global producers of brazed aluminum heat exchangers, the only one in North America. They're also an independent provider of equipment, and I think this is important because a good amount of their competitors actually own like the end molecule or the production plant. Chart is a pure equipment provider, so they're sort of a Switzerland neutral third party, which I think is a more attractive business model and less capital intensive. 64 manufacturing facilities worldwide, 50 service centers, 85% of their products have IP associated with it. Right now, the market cap's around $5 billion, enterprise value is around $9 billion, and we'll get into the debt load in a minute. Part of the current pessimism with Chart is that its traditional markets, LNG, traditional oil and gas, industrial gases market, a lot of the market, I think, still perceives Chart as primarily focused on those end markets. But really, in the last 5 years under the new CEO, the company has pivoted pretty strongly to the markets on the right. These are secular, high growth, newer, smaller, but growing markets. Hydrogen, helium, water treatment, carbon capture, nuclear, space exploration, clean food and beverage, and with the addition of Howden, clean mining. I'll get into some of these individual end markets later. The transformation has happened under this lady, Jill Ivanko. She's been CEO since 2018. I've gone back and reviewed sort of the track record of Chart. I've been pretty impressed. She was the CFO prior to that since 2017. There was some C-suite turmoil when she became CEO, but I think she's really righted the ship. You can see she's a financial role, so I've found her to be very financially savvy at other industrial companies in her prior experience. And she's been behind this big pivot. Now, before Howden, Chart was already on this sort of business transformation. If you look at the chart on the left and the left side of the chart on the left, you can see that between 2016 and 2020, their average orders per quarter were about 250 million. During 2020 and 2021, so global pandemic, valuations crashed, probably especially for smaller private companies. Chart really made a bunch of bolt-on acquisitions and minority investments, and what's looking to be probably a great opportunity to do that. You can see their average orders per quarter in 21 and 2022 had increased by about 200 million a quarter, and they had deployed, between 400 and 500 million, and that's due to the growth of these end markets, as well as these bolt-on acquisitions that gave them these capabilities in water treatment, hydrogen. That Alabama Trailers one makes these giant tanks for space exploration. So really interesting opportunistic buys here, I think, and shows management savvy. However, that all changed when they decided to buy Howden. The market hated Howden. As you can see, the stock had gotten up to almost $250 a share in 2022. Russia's invasion of Ukraine had spurred a lot of optimism for their LNG business. Again, the market really perceives this almost as a pure LNG play, which we think is wrong. But as soon as they announced Howden, you can see the stock pretty much crashed, and the stock is pretty much still there to this day. This is part of the reason why they hated Howden. $4.4 billion acquisition, made it 12.9 times EBITDA. Took on a lot of high yield debt. And if you all remember, the fall of 2022 was when interest rates were still rocketing higher, and people were freaking out about a recession that so far hasn't come. You can see company loaded up with 3.5 billion of debt between 7.5 and call it 9.5. You can see the 1.5 billion in variable rate debt. And then what was really a killer was that the company had to sell equity after the stock crashed at around $118, which is pretty much where the shares are right now. I don't know if management couldn't sell equity before announcing due to legal reasons, or if they didn't think the stock would fall as much as it did. But clearly a dilutive raise, but it's also in the past. But here's why we like Howden and why Chart likes Howden. It's based on two big themes. Based on really compelling synergies, the acquisition is much cheaper than let on. Second is that Howden actually transforms Chart's business model in a significant way to become less cyclical and more resilient. So not only do I think that the acquisition is going to allow them to pay down that debt, but I think the company is going to get a re-rating higher on the other side of this if they execute and delever. And there are large cap industrials out there that trade at 20 to 30 times forward earnings. And Chart, based on their guidance, which we'll get to in a minute, trades at a high single-digit multiple right now. So there's a significant prospect for a real big upside here. First, on the synergies and why it makes it cheap. First, Chart has already divested 500 million in non-core businesses. So that 4.4 is already down to 3.9. 200 million of which was divested in the fourth quarter and has not yet been reported. They report on February 28th. Second, cost synergies are on track. They forecast 175 million. in year one, 250 by year three. As of their investor day on November 27th, they'd already achieved 152 million. So they're right on track here year one. But the story is really in the revenue synergies. Howden is highly complementary from a product standpoint. So Chart and Howden together can go from selling really book and ship equipment to total solutions, which gets them more embedded with customers, increases margins. In addition, Howden was based in the UK. Big presence in EMEA, Europe, and Middle East and Africa. Chart was mostly focused in the US. There are huge geographical synergies as well. So now Howden customers can buy Chart equipment and vice versa. Importantly, the service, by acquiring Howden service centers, you can now service in the aftermarket Chart equipment in, say, the Middle East, where Chart didn't have that capability before. The company has already achieved $400 million in revenue synergies, which is huge considering they had forecast $350 million in revenue synergies by year three. We're only, this is as of November. They closed the acquisition in March. So this is 8 months. They have already exceeded their year three revenue synergies. So just doing a little bit of math, headline valuation was 12.9x EBITDA. You factor in the divestitures and just the year one cost synergies, we're already down to 7.5. It's much more palatable. Factor in the divestitures, year one cost synergies, and the revenue synergies at a 22% EBITDA margin, which they recently reported in Q3, you're down to 6.7. If you factor in year three cost synergies and just year-to-date revenue synergies with nothing else in the next couple of years, and the divestitures, we're down to 5.7. So you can think about the way revenue synergies are going, what this will actually look like, 3 years from now. It could be, a greater than 20% EBITDA yield in what seemed like an expensive valuation. But what I'm really excited about is the composition of Howden's business. Howden, prior to Howden, Chart had very little percentage of its revenue tied to, we'll say, recurring aftermarket sales. This is repairs, upgrades, digital uptime, software, and service contracts. Businesses that have this with their equipment, that revenue is much more stable than equipment sales, which can be cyclical and fluctuate a lot. This revenue is more tied to the installed base and is more of a consistent grower. Howden had 48% of its revenue coming from aftermarket sales, which is huge. It's almost a razor and blades model. So now you have Chart going from what was known as pretty much an equipment company, now has combined about 30% of their orders and sales coming from this aftermarket segment, which is somewhat recurring. In the third quarter, that segment was up 22%. Pro forma was up nearly 16% for the first 9 months of 2023, with a book-to-bill greater than 1. And the gross margins of the segment are higher. Part of being a generalist and going across segments is that you can find connections where you might not otherwise if you're a specialist. So it struck me that Chart is now a similar business model to something I've seen before in the tech world, where you have sort of this growth cyclical hardware business, where you have 20 to 35% of the business with services kind of tied to the installed base. The most famous example, Apple. Warren Buffett did pretty well with that thesis when Apple was perceived as a cyclical hardware company. We all know the services segment is now more than 22%. Another example is the semi-caps, semiconductor equipment companies. We have Applied Materials and Lam Research in the Stone Oak portfolio. We've had them for a while. We love those businesses. They get cheap when the semi cycle turns down, but each has about 20 to 35% of their business in these recurring services. And these have all been very successful stocks. They've all re-rated. You see Apple at 29 times forward, the semi-caps in the mid-20s forward earnings. So Chart has some debt to take care of, but given enough time, why not? It's currently at about 8.3 times its forward guidance. As you can see on the lower left, the company's pretty diverse now. You see the aftermarket service and repair, the clean energy transition, hydrogen and helium. You look at those parts of the pie year to date through 2023, that looks to be about 60%, 2/3 of the business. And the market still thinks it's an LNG, traditional energy company. Some high growth markets I'm very excited about are hydrogen and water treatment. I'm just going to go into them quickly because I'm running short on time. Hydrogen is known as the Swiss Army knife of decarbonization. I think it could see big growth towards the end of this decade if they get the cost of hydrogen molecules down. In October, actually, the Biden administration announced $7 billion for 7 giant regional hydrogen hubs across the US, which is supposed to catalyze another $40 billion in private investment. Chart's equipment, same equipment that goes in for LNG, goes for hydrogen too. Chart doesn't have to change its manufacturing lines. I think it's a big opportunity, but it's not just the US. Hydrogen is getting adoption globally as well. Also, water treatment. I don't know if anyone here owns 3M. I'm sorry if you do. PFA, the EPA is cracking down on PFAs or forever chemicals. Should be much more water treatment regulation. So 2023 guidance here, what I like to point to is 2024 guidance. The market clearly does not believe management's guidance, but Jill Ivanko has a pretty good track record. Current share price is $118. Their chart is forecasting $14 plus next year. And to get down to a leverage between 2.5 to 2.9 times EBITDA by mid-year. We're at 3.6 now. So for all the reasons I listed, secular growth, synergies, I believe these numbers. And the stock obviously looks cheap. Chart also gave a 3-year outlook at its recent investor day. Look at mid-teens CAGR organic revenue, gross margins around 30 today. They think they can expand it to the mid-30s. Earnings per share, mid-40s CAGR. Obviously, there's a big jump up next year, but even factoring that in, it's still sort of a 10% low double-digit earnings CAGR. This is a compounder at a very low PE ratio. So I think our price target we gave was 300. If you just take 45% earnings CAGR for the next 3 years off of this year's forecast, you get to 1874, 1875. A very undemanding 16 times multiple on that numbers gets you 300, and I think that could potentially be conservative. Chart has said this guidance is conservative as well. They did not factor any big LNG projects already in the backlog or any revenue from the just announced US hydrogen hubs, because that could take a while and it's the government. So just very quickly before I go, risks, reason for reason pessimism. Q3 headline revenue and earnings came in a bit lighter. This, I think, is much ado about nothing. There were orders that got pushed out of Q3 into Q4 and Q1. Chart has had a minuscule cancellation rate for orders historically and since Howden. This is just, I think, the machine seeing a headline miss and punishing the stock. Obviously, there are concerns about hitting 2024 guidance. Management has said they have a higher than normal backlog covering this year already. So they're already ahead of the game. And with Howden, they're becoming much more ingrained into their customers' plans. They're more of a partner than just an equipment supplier. Now, there was a recent bit of bad news flow. January 26th, the Biden administration announced a pause on new LNG export terminal approvals while the DOE assesses updated economic and environmental impacts. Again, this is just new approvals. There's already several US LNG projects ongoing. This doesn't affect the ongoing construction of the giant LNG terminals. I think there's enough ongoing LNG terminals in the US to triple the current capacity. And Chart announced a bunch of big LNG wins recently. They're basically all international. There's also the possibility that if there's stricter environmental regulations around flaring or methane emissions, that could actually be a benefit to Chart since they have nitrogen removal equipment, this technology they developed called IPSMR, which lowers emissions, and carbon capture it could see more adoption as well. And again, if natural gas is replaced by hydrogen, Chart plays there too. And with the addition of Howden also brought in mining equipment. So more electrification, you need more copper and more lithium. That part of the Howden portfolio will benefit. So to sum up, Chart's acquisition of Howden has transformed it into a more diversified and stable business. It has exposure to secular growth markets, and it is currently a lot of the pessimism is garnered by anxiety around the acquisition and debt pay down, and not realizing that this transformation has taken place. I know I'm pushing my time, so if we have time for questions, I'd be happy to take some. If not, please feel free to email me at the email address at the bottom left there. I want to thank Divya, Christian, and Braden for having me. This is a really great event, and I will cede the floor.
Thank you, Bill. If anybody has any questions, feel free to ask them in the Q&A section. I see there was one asked, but you answered it literally as it got asked. So I think we're good there. So guys, feel free to ask some in the chat. In the meantime, I'll ask one that was in a comment on your report on the site. And Michael Ma asks, given the departure in typical M&A approach with Howden, what might investors expect for future M&A? For example, larger, more transformative deals, or back to smaller incremental bolt-ons?
Yeah, this is a good question. And the answer, the portfolio is pretty filled out by now. Of course, management had said that prior to Howden, in terms of just the end markets and the technologies needed. Right now they're focused on debt pay down. Management has said they're not going to do anything until debt is between 2 to 2.5 times. They could get there by the end of this year, if all goes well. And then after that, it really remains to be seen. I think Howden was the biggest position to date, so that obviously surprised the market. They haven't outlined a new strategy. They could be pivoting to, buybacks and maybe a dividend if they think they're good to go now in terms of their portfolio, but it's really unknown at this point. Historically, they've done a lot of bolt-ons. Howden was a bit of a departure. We'll see how it works out, or if they think they're good now, and they might pivot to buybacks or dividends. It's basically unknown.
Got it. Okay, thank you. And we have time for one more before we move on. And participant David asks, what are the key risks to your view? Are there any competitor threats? And what is the ROIC of the business?
Yeah. So the ROIC, if you look in the past, is not going to give an indication. It looks as though I think this could be a mid-teens, low 20s ROIC business once all the synergies are achieved. And it's a pretty capital light business. They forecast their free cash flow is going to be about 95% to 100% of net earnings going forward. That's why I like the equipment stocks very well. They don't have a lot of direct competitors. They have competitors for individual pieces of equipment because they're so diversified. I would think, and a couple of them come from Europe, like Lind and Air Liquide, I think, but those companies also own the hydrogen plant or the end molecule. And I think that's what sets Chart apart, is that it's a neutral third party and it has a lot of capability, and it won't be sort of competing with any customer that it would sell its equipment to. I hope that it's. Oh, also Plug Power bought. They want to be vertically integrated. I don't know if you guys follow Plug Power. They are trying to be all things hydrogen. They used to sell hydrogen fuel cells for forklifts. They bought a hydrogen equipment company a few years ago, and they're trying to become this huge hydrogen company. They just issued a going concern warning in their 10K, I think, or 10Q last quarter. they have negative gross margins right now. Their business is on thin ice, shall we say. So potentially, at least in the hydrogen space, um, they Chart may gain a leg up on Plug, which is more of a high profile hydrogen play. But I hope that answered your question. The Chart does not list its list of competitors in its 10K. You have to kind of go look for each segment.
Got it. Awesome. Well, thank you, Bill. There are a few more questions, but we're out of time, so we'll address those on the report on Sub-Zero, and you guys are of course welcome to email Bill as well. But Bill, thank you so much for the presentation and joining us.
Great. Thank you, Christian. Thank you guys so much.